and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at an issue that's weighing on the minds of all market participants, the fast approaching redemption of the FCNR deposits that were mobilized almost on a war footing in September-December 2013 in a bid to shore up the rupee. But before we do that, and I ask my experts, Usha Thorat, former Deputy Governor RBI, and Hitendra, Head Global Banking and Markets, HSBC India, to run us through the various scenarios and how each of these could play out. First, a brief background. In September 2013, in the wake of the taper tantrums following then Fed Chairman Ben Bernanke's reference to a possible end to quantitative easing leading to large-scale forex outflows from India, the RBI opened a swap window to encourage banks to mobilize overseas funds to shore up the rupee, which had plunged against the dollar. The RBI offered to swap these dollars mobilized by the banks for rupees at a concessional rate of 3.5%. The prevailing then rate was in the region of 6.5%. Roughly 34 billion was mopped up in the process through FCNR deposits and bank borrowings, of which about 26 billion was in the form of FCNR. These are now due for redemption, that is, they are up for repayment. The question weighing on everybody's mind is how will this impact the market? Remember, back in 2013, an outflow of a much smaller order of about 7 billion a day was enough to cause mayhem in the market, and we're talking now of close to 4 times that amount, 26 billion. So with that, it's over to you, Usha and Hitendra. Let me start by asking the question that everyone is seized with right now. What are the fears, and are these overdone? Financial markets have a habit of anticipating the worst, but usually things are never as bad. Can we dare to hope that this time also it's going to be any different? We'll get into the details a little later, but for now, let me ask you to briefly list the main fears and ask, are these exaggerated? Let me start with you, Usha.
Mythili, I think the fears are overdone, honestly, because there has been a clear assurance from the Reserve Bank governor that both dollar liquidity and rupee liquidity, will be provided in case it is required. And there is also the reserves of $357 billion. So I think the market fears are overdone. The only issue with people were really wondering is when most of the thing has already been bought forward, and when the bankers have to deliver the dollars to the Reserve Bank, whether in case their exporters are not able to honor their contracts or other people with whom they contracted, then these would need to be rolled over, and whether at that point of time the sufficient dollars would be available. So I think that given the the country's position and the rating and the fact that banks can if necessary borrow these dollars, I really don't think there'll be any real worries about delivering to Reserve Bank. And even if there are some blips here and there, I think the Reserve Bank statements have been very, very assuring.
Hitendra, would you agree with Usha's assessment as also her reasons? Of course, in some ways, this is not the first time. We've done something like this in the past as well. We had the India Development Bonds, the Resurgent India Bonds, and the Millennium Development Bonds in the past, though the order of magnitude was much, much less. So, would you agree with Usha?
Yeah, I think we need to sort of start thinking in terms of who has the dollars currently. Currently, the dollars are with the Reserve Bank of India. And who has the INR liquidity, though that's the banks who know that this was a 3-year contractual agreement. I think there is all the banks, at least because it was largely around about a dozen banks or so. I think and you look at the transactions that took place in the last quarter of 2013, you will see there's significant amount of volumes around 3-year transactions. So essentially, from a rupee liquidity perspective, the banks will expect to get assets which will get converted into cash effectively in this quarter. As long as that INR liquidity is available, RBI they will give the INR back to the RBI, and RBI effectively will then provide the dollars back. As Mrs. Thorat mentioned, I think there are 2 legs to this transaction. One is the initial one where dollars are brought in by NRIs to banks and who give the dollars to RBI, and RBI gave the INR. So the first part is sort of more or less complete. The second part, which is the one where how RBI has hedged its own delivery of dollars, which is by way of buying dollars predominantly after the new government got sworn in and we had this deluge of dollars coming in from the FPIs. I think typically to coincide the outflow of dollars, the Reserve Bank of India in its market operations continue to intervene in the spot market and continue to then undertake forward transactions such that bulk of the dollar deliveries it would receive around the time that it has to deliver dollars back to the banks that originated the FCNR scheme. And I think that's where a little bit of a mismatch is possible, as in that those banks that have contracted with RBI under the forward contracts would have the assumption is that they would be able to source the dollars themselves. Typically such large quantum, it is not that the banks would have provided an open-ended position to the Reserve Bank of India. They would have contracted at the back end with their own customers, typically exporters, and historical experience suggests that not every dollar that is contracted by exporter is delivered on the due date. Some of it is delivered subsequently, some of it is early delivered, etc. So it is this timing mismatch. I think in terms of market fears, I frankly think, I think most people realize that the only issue at stake here is that you could have a timing mismatch, that you have to deliver dollars to RBI on, let's say, October 31, November 30 or December 31, and you receive a month later, 2 months later, 3 months later. As I understand, I think it's about $24 odd billion in this quarter, in the last quarter, that has to be delivered, of which I believe RBI has already taken delivery of $5 billion, or that's market estimates, not, these are not exact numbers. So if we are talking about $19 billion, I think that level of dollars to borrow, if the situation does come about that, let's say, there is a 50% exporter non-delivery, I think it will have a result more in the forward premium market than in the spot market. I think I've read some commentary around how this will lead to a surge in demand for dollars. I think that's slightly wrongly understood. If at all it has an impact, it is purely a timing mismatch, and if there's a timing mismatch, a bank doesn't go and buy dollars, it just desperately looks to borrow dollars. These are two different transactions altogether.
Okay, Usha, Hitendra is slightly less sanguine than you, and though he's talked about the transaction, for the benefit of our viewers, can you really run us through the entire process? What happened when banks swapped the dollars mobilized by them with the RBI? And is it simply a matter of buying back these dollars from the RBI, which has reserves? So in which case, why is there so much anxiety in the market? Is it, as Hitendra said, purely a question of frictional problems?
Mythili, the real issue is the mismatch issue, both in terms of, see, what happened when the banks went out and borrowed the dollars and delivered it to RBI. After all, these were either the NRI individuals who did, and they in turn might have been funded by the banks themselves. So basically, it is a question of a borrowed dollars. These are borrowed dollars which came to the system between September and December 2013 for a 3-year period. And at that time, the Reserve Bank offered a window at 3.5% against the prevailing rate of something like 7%. So there was clearly a benefit in doing this transaction with the Reserve Bank, and that is why the quantity of dollars that you got at that time was fairly significant. Now, what has RBI done in the meantime? Just like Hitendra explained, RBI has in turn, when the dollar position improved and the country started attracting dollars again, RBI then went and contracted. I mean, it's done usually in 2 legs, in the spot market and then in the swap leg. But RBI covered itself forward, and quite a bit of the dollars have been covered forward, which really means that it does not have to go from the reserves, because the market will deliver those dollars to the Reserve Bank. Now, where will the market deliver those dollars from? Either they have in turn contracts with, like Hitendra explained, the exporters, or with other people who have dollars ready to deliver. Now, in case they are not able to do that, what do the bankers do? They avail of their credit limits. Now, these credit limits they would avail of, and then they would again, deliver the dollars under the forward contracts. And on the other side, the first leg of the contract, in case they've created rupee assets of the similar maturity, then there is no problem. Or if these rupee assets had been created for lending, some of which is not coming back, then there would be a rupee liquidity problem. In any case, on both sides, I feel that the present conditions are such that we don't really have to be too concerned about any blips in this. It's a settlement process, and it will go through. So I would say that I think there are certain ifs and buts and certain uncertainties, but by and large, I think the market has been expecting this, and I think it is well prepared to cover it. And Reserve Bank has clearly given an assurance that in case there would be absolutely no doubt about the rupee liquidity part about it, but as far as the dollar liquidity part of it is concerned, whatever is necessary to prevent an undue volatility will be undertaken.
Hitendra and Usha, you both explained the entire process very simply for our viewers. But even so, Hitendra, what percentage of these deposits do you really expect will be rolled over? Earlier, the view was that since most of these are leveraged deposits, that is deposits created out of funds that are borrowed at ridiculously low rates prevailing abroad, most of it will not be rolled over. But have things changed post-Brexit? Does the scramble for yields that we're seeing in the market today make these deposits attractive, both for banks and even for depositors without a concessional swap window?
Mythili, I agree with you. Most of this, because the banks were also allowed to lend, to the FCNRB, under the FCNRB, for individuals who wanted to place these deposits, it certainly was an advantageous position, which facilitated this whole transaction. So therefore, I would expect some of them to be rolled over, because still India, for the NRIs, still it continues to be an attractive proposition. So because on the FCNRB, you do get a little more attractive rates than you compare to international rates. So I mean, of the individual deposits which are not leveraged, I guess quite a bit of it would be rolled over. But I would say the leveraged deposits would be the significant part of it. And even there, I would say that, I mean, I don't really have an estimate of how much would be rolled over, but even if it is not rolled over, I think it could be replaced by other, lines of credit. So and like I said, even if that somehow, because everybody finds Indian banks are borrowing too much in the market, money markets at that point of time, maybe, one would have to then, if necessary, the Reserve Bank will have to come and roll over the swaps.
Hitendra, let me toss that question to you, Hitendra. What is your estimate? What percentage of these deposits will be rolled over? Because post-Brexit, we are seeing a great deal of interest in Indian assets. So will we see these deposits getting rolled over even if there is no concessional swap window, Hitendra?
No, I think, no one really knows the actual extent of leverage, but I think broadly it's fair to assume that of the $25 odd billion that is coming due in this quarter, in the coming quarter, I think about 90% is leverage money or so. So you have to assume that that money is going to go back. Okay, that leaves the principal amount of the customer, which we are talking about $2.5 billion, maybe stretch it to $4 billion, because no one really knows what the various leverage ratios offered by different banks was.
Would you say that 90%?
I think at this point of time, given the current FCNR pricing we have, it's very difficult to see what's in it for the bank or what's in it for the customer. I think, let's just forget whether the customer will get higher returns in it. It's not just the customer. I think even if you are a bank in India and you get an FCNR deposit today at, let's say, LIBOR plus, you'll have to give something, maybe 100. Yeah, so I'm saying that I think at LIBOR plus 100 or LIBOR plus 150 or LIBOR plus 200, those are the kind of ranges at which you would have to offer someone to, take the deposit out of wherever else in the world and come to India. If you look at the current swap rates, which are just around 6.5–7% or so, it doesn't really become particularly attractive. You get deposits at something like 7.5 to 9%, which you can procure locally as well. So I think it's not just about whether the NRI has alternate investment avenues or savings avenues or not. It's also about whether the banks domestically will want to retain these deposits at these kind of prices. So I think it's both legs here in terms of how much will stay back. I think just on the issue of what are the risks or what are the factors that I think policymakers want to be a little focused on. One we already spoke about. There is a potential for a frictional mismatch between the day of dollar delivery by banks to RBI versus when they themselves receive, and that's a manageable thing. It can, as long as I think the market forces themselves are self-correcting. If forward premiums fall, naturally you'll have a lot more dollars coming in from FPIs and other sources, etc. I think the only other issue which possibly, I think from a policymaker perspective, there would be, and I'm sure RBI is cognizant of this, is the fact that this is going to be about 165 or 170 or 1,000 crore reduction in the liability base of banks in the midst of what is consistently repeated as an accommodative cycle. This can actually be a little counter-cyclical. It can force banks to keep their deposit rates higher than where they might normally have kept, given the state of liquidity, given the state of credit demand, given the state of interest rate cycle, etc. I think that's the only other element that, and I'm sure one of the reasons why RBI is re-emphasizing that they will do more on liquidity than many analysts actually thought that they might, is also to address this potential concern. What you don't really want is deeply into a rate cut cycle, deeply into an accommodative cycle, deeply into a cycle where you're really hoping for capex to start picking up on the back of some of the work done by the state sector. Is you don't want really deposit rates to start inching on the other direction. And I think that's to me frankly, the dollar mismatch is a manageable thing. These are professional institutions. They know they have committed to deliver and they have to manage their own risks. So I don't really think authorities really need to step in unless it gets completely out of hand. But the other issue is more, I think, fundamental, where where if you are going to see the system lose roughly 50% of the deposit collection that it has done in this financial year. I think in this financial year so far we've seen about 3.5 lakh crores of deposit mobilization, and you'll have about 1,65,000 crores leave in about 3 months time or so. Whether that will have some consequences in the loan and deposit market, I think that would be more a policymaker concern rather than the dollar mismatch issue to me.
Okay, so Hitendra is more worried about the rupee market than the dollar market. Usha is not very worried about either. She thinks the RBI can manage, but I'm afraid on that note it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the FCNR redemption scenario. Are the fears exaggerated? What are these fears? With a panel of experts, Usha Thorat and Hitendra Dave. Usha, let's imagine the worst case scenario, that only a tiny fraction of these deposits actually rolled over. Hitendra said more or less 90% is unlikely to be rolled over, which means that we have to meet redemptions of about little over 20 billion. What are the options before the RBI? Should it meet the full requirement from its own reserves, or should it try a combination allowing some kind of market adjustment and some sale of dollars from its own reserves? Remember, the governor in his second bi-monthly statement in June had said that banks should not take it for granted that the RBI will provide the dollars. So what is the various scenarios before the RBI? What can they do?
Mythili, I'll just make one more point, and which is about the, you said I'm not worried about the rupee liquidity. What I just wanted to say is, yes, that is the reason why the transmission has got delayed, which is the point I've been making earlier also. People have not really transmitted the impact of the accommodative interest rate stance into the market, partly because of the concerns about the FCNR redemptions in this quarter. So having said that, I think I would agree with Hitendra. I think he's made a very valid point that as far as the dollar liquidity is concerned, Reserve Bank, has made it clear, and I think the market is also used to the way Reserve Bank deals with these kind of deliveries. And I think there have been rounds of discussions, as I can understand, with the bankers on what are the kind of, under the permitted tier 1 capital lines of credit which they have. What is it that they can borrow? What is it that can deliver? Banks know they have to deliver it. It is really the impact on the liabilities of the banking system that the banks would really need to, find out how much liquidity is really needed, and that is why the Reserve Bank has to upfront so much of open market operations. So now let us look at assuming what are the options available. Obviously, the options which are available under this kind of a thing is that these are dollars which had to be repaid to the market, right? And ultimately it has to be replaced by either the delivery of dollars by the exporters or other contractors who have come in to deliver it to the banks. And since we've already seen that most of it is leveraged, so it's really borrowed funds. So they in turn borrow funds, or the banks in turn borrow funds. And Hitendra has clearly explained that this is not really that much advantageous, because there are no concessions any longer, and therefore it's not that attractive to go and mobilize these kind of dollar funds, because there is no concession available. In which case the only option then left is for the RBI to selectively see how much is required and roll it over, roll over the swaps themselves at the present market rates.
Hitendra, Usha was saying that the RBI really is well equipped. And it is true that we have about 366 billion of reserves. So there's really no need for us to worry unduly. But the fact is that while markets can perhaps deal with an outflow of this order comfortably, if it were to happen over a number of days, one can never tell with markets, and you could have frictional liquidity suddenly spilling over and engulfing the market. So if you were to put yourself in the governor's shoes, what would you be more worried about, and how would you be thinking in terms of tackling that anxiety?
Well, I think this is very honestly, I think some of us in the marketplace have been a little bewildered by the amount of noise which is coming through about this subject, because my genuine belief is this is a well covered product. The banks know they have to deliver INR, they have made investments in assets which will get liquidated around this time. The Reserve Bank of India has more than adequately covered the dollars that it has to deliver to the banks. The banks with whom it has to take deliveries are I think fairly sophisticated players. They would know that yes, they are not going to receive all the dollars that they are obligated to deliver, and they would be having their plan A's and plan B's and plan C's, and the worst case is that it has an impact for a short period of time, could be anywhere from 1 month say stretching out to 6 months or so, where because of the need for certain banks to borrow dollars, the effect on the market for borrowing and borrowing and lending in dollars, which is really forward premiums, comes off a little bit, maybe comes off more than a little bit, but we've had those cycles of sharp dips in forward premiums in the past. So from a structural perspective, I really don't think that this is something which is one should get particularly perturbed about. But to the point that Mrs. Thorat was making earlier and I also made earlier, I think that's a more, you ideally would have thought that given the change in the liquidity stance, given the change in, given the significant amount of cuts that have taken place and there's still talk of further cuts in the air, etc., the actual fall in lending and deposit rates has not been commensurate, and to the extent that this large redemption is playing on the minds of bankers, I think once this is over, we will really know what the impact thereafter will be. So to me, frankly, the only issue from a structural perspective that one needs to be sort of keeping in mind is this holding back transmission? And if this is indeed, if it is accepted that this is holding back transmission, then what should the Reserve Bank of India be doing to counter that by way of proactive injection of INR liquidity, so that bankers know that for such a large outflow of deposits, they do now have a fresh pool of liquidity from which to garner deposits, whether it is 20% of this or 50% of this or 100% of this, doesn't really matter, but as long as the gap is not as large as this. Okay. Apart from that, I really don't think, there can be the unknown unknowns, but otherwise, the best as I can judge, I don't think we are looking at anything cataclysmic of any nature whatsoever.
Usha, it's reassuring to find that both of you are not think the fears are a little exaggerated, because markets do tend to exaggerate fears. But even so, which market do you see more impacted, the rupee market or the forex market? The general expectation is that it should be easier to manage rupee liquidity. But even so, given the repercussions of a sudden tightening in rupee liquidity, it could have implications. And Hitendra talked about perhaps some kind of special dispensations. Would that be called for? And if so, what kind of dispensations in terms of CRR, SLR? Is anything possible at all?
Mythili, I think the existing instruments of repo and OMO are quite sufficient. I mean, I don't really see the need for a CRR or an SLR kind of cut. And also, like I said, there are, and Reserve Bank can also manage liquidity through the swap market, both the dollar and the rupee. So I would say this is a tool which, one can use it. After all, you can use it. It's a bunching issue, so you can always phase it out. So I really feel that there's no really need to go and explore extraordinary measures or anything special, by way of CRR, SLR, which would not be warranted otherwise.
Would you concur with that?
If I can just come in there, Mythili, I think the one small point which, and I'm sure this is on RBI's mind, and we have seen them react to it over the last few months, would be that should, let's say, the domestic liquidity creation through RBI action, either through the increase in their FX assets or their rupee assets, not be of the quantity that helps address some of the deposit outflow issues. I think the issue there would be that, yes, of course, there is the LAF or the repo windows, and banks can always borrow against that. But I think over the last, ever since LCR, the liquidity coverage ratio concept has come in, that itself has become a constraint on certain banks' ability to tap the repo window, even if they have excess SLR, as we call it. And I think that would be one thing which I'm positively sure that will be one of the things on RBI's table of options of menus to try and see if they can permit a further dip into the LCRs to allow banks to be able to tap the liquidity, which RBI can obviously has various windows for.
Absolutely. I suppose the proof of the pudding is always in the eating, but I'm afraid we're completely out of time, so I'll have to end this discussion here. The good news is that both Usha and Hitendra are confident that we really have nothing very much to worry about come September, when the FCNR deposits are up for redemption. There could be brief periods when markets are a bit volatile, but post the global financial crisis, that's not saying much. Markets are more often than not in ferment. That, I think, is the new normal. Thank you so much, Usha, as well as Hitendra. Thank you very much for joining us. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.